Okay. I'm assuming you guys are watching these or no? I'll take that as a no. So I guess, huh? Okay, you are watching. Okay, so I'll continue to go ahead then and do this and place them up there. You can go back and watch these, obviously. If you have areas with questions, of course, you can also always ask me. But okay. All right, so this heading slide here for Chapter 6 is variable costing and segment reporting. I'm not going to get into variable costing in this class. This is something that is very specific to accounting majors, and when I've taught Accounting 305, I've ended up realizing that most students forget this anyway, and we end up teaching it again in the cost accounting class. So if you are an accounting major, you'll see it in 305. If you're not an accounting major, no one's going to ever say, hey, do you know how to do variable versus absorption costing? It's just never going to come up. Okay. Segment reporting, and more probably appropriately, segment analysis, is something that you could run into, and that these days, the way we look at a company, the way we evaluate a company, even though for our external financial reporting, we may sit there and consolidate a set of financial statements and report just, a company-wide set of information. The way the chief decision makers in the companies are going to look at it is they're going to break the company into either geographic segments, or it could be by various territories, such as a sales territory geographically, or it could be by a particular center of the business. If we're dealing with a hospital, we might break up that hospital by the surgery versus the ER, etc. Okay? And so when we analyze a company, we obviously are going to want to understand which parts of the company are contributing more towards our profit margins, towards our fixed cost, etc. Obviously, we have segments that are contributing more towards our fixed costs, then we're going to want to keep those segments. If we have segments that are not contributing towards our fixed costs, not contributing towards our profit, those might be some segments that we want to eliminate or that we want to reduce an emphasis in. Okay, so when we look at the company, we're going to analyze it by segment. And we're going to use the contribution format financial statement. And we talked about that in Chapter 5 when we talked about our contribution margin and our break-even analysis, our cost volume profit analysis. We talked about what? Sales minus what? Variable costs were equaling our contribution margin. Okay, and so if we had 100 of sales and we had variable costs of 7, obviously our contribution margin is going to be what? 30, right? And then we went ahead and considered our fixed costs. We would take our fixed cost off, say 10, whatever, and I'm just making these numbers up. That would give us what? Operating income of, say, $20 in this little example, right? Okay, that's a contribution format financial statement. And what we're going to do here is see that when we look at our segments, we're going to set up their financial reports like this. Again, these are for internal uses. You don't report this externally. This is for an internal use that we can quickly look to see to what extent a particular segment is providing a operating profit, operating income that then can be used to cover the overall fixed cost of the company. Now, when we look at this, we're going to see that we're going to break our cost into those that are traceable. Okay, you can see this down here on this bottom box here. Those that are traceable versus those that are common fixed costs. Traceable fixed costs, very descriptive term, are traceable to the particular segment. And so when we're analyzing to see if a segment is profitable or not, we're going to obviously trace the fixed cost to those traceable segments. Okay? We're also going to see something called common costs. And when we have our common costs, we are not going to trace those to the individual segments. Now you sit there and say, well, then why are we even looking at them? Well, we're going to be interested to see to what extent the profit margin of each segment contributes to those common costs that are not going to be traceable to each segment, and that's going to help the overall profitability of the company as we look at that. Okay, so that's where we're going with this discussion. And so we start to take a look at, well, what is the difference between a traceable cost and a common cost? A traceable cost is a cost that if we got rid of the segment, the cost would go away. For example, this example, the computer department. If we get rid of the computer department manager's salary goes away. That's why that guy's so nervous, right? Because he's sitting there saying, well, look, if you get rid of the computer department, I'm going to lose my job, right? Okay, so a traceable cost is a cost that would be eliminated if we got rid of that segment. For example, you get rid of the computer department manager's salary goes away, right? Okay, common costs are not affected by the elimination of a department. So if you get rid of the computer department, yes, we've eliminated the computer department manager's salary, but we haven't eliminated the CEO salary because he's still over the other divisions of the company, whatever it is, right? If we had a, I don't know, television department or something, the CEO salary would still continue on, wouldn't it? Okay, so the CEO doesn't go away because you get rid of the computer department. That person is still over our, just to use an example, our 10 other departments. It would still be there, right? Those are considered common costs, okay? So traceable costs, you trace them to the segments. Common costs, what? You do not attribute those to the segments. However, we are going to be interested in them and seeing what is the overall profitability of the company, and we're going to want to analyze to what extent what? Our departments will contribute to those common costs. Okay? Now, when we look at our traceable costs, something that could be traceable at one level of the company may not be traceable at another level of our operations. Okay? For example, if there was a fee charged to each plane that lands in an airport, airports will charge landing fees to the airlines that utilize their airport. Okay, you can charge a landing fee to a particular airplane or a particular flight, I should say, but you can't sit there and do what? Allocate those landing fees appropriately to the business class versus the, regular class, whatever, because what? That whole plane had to land, didn't it? And just because you got rid of the business class department, if you were Southwest, right, they don't have a business class, you still have to pay that landing fee for that whole plane, right? So it could be what? Considered traceable at the flight level, but not traceable at the plane level, or I should say the different class level. Okay? Okay, good. So let's just see how we can come up with segment margin and see how we're going to be able to determine if a particular segment is profitable. And when we look at these, we're going to what? We're going to trace the traceable cost to each segment. Common cost we will not in determining the profitability of each segment. Okay, and so that's what this slide is telling us. Take your fixed cost. Obviously, the variable costs are already traceable to each item. Those are variable costs. We have to incur them to even have a product to produce, right? But then when we get to the fixed costs, we're going to consider them traceable or common. If they are traceable, we will obviously trace them as the name indicates. We will trace them to the various departments, products, segments, however we're looking at this. If it is a common cost, we will not allocate it to the segments. We could also do it by product. We'll see here in a second. Okay? All right, so let's just go ahead and take a look at this Weber company. They have two segments, two divisions, the computer division and the television division. Okay, so we come over and we take a look, and if we're looking at the overall television division now, we could see that we would have our sales minus our variable cost of goods sold. Cost of goods sold is going to have our product cost, right? Our manufacturing cost, our direct labor, direct materials, our manufacturing overhead are going to be in our cost of goods sold. We could have other variable costs such as what? Selling and administrative variable costs gives us the contribution margin. Now, we have traceable fixed cost here of $90,000, and so the margin for this division in this example is $60,000, right? Notice we only took what? We only took traceable fixed cost. If there are non-traceable fixed costs, we do not consider those in the evaluation of the profitability of this margin or of this division or their division margin. So you come over, and I believe that's the same slide again, unless I'm missing something. So let's come over and let's look at this example where we have the company overall, and then we have our two segments. So this is the overall company. What did they call this company? Weber or something? Web, whatever they were. Okay. Okay, that's the Weber company in this example. And then we had two divisions. We had what? Television and computer, right? And so notice we are using our contribution format financial statement. Our sales minus our variable cost gives us our contribution margin, and then we only take the traceable fixed cost to each department. 90 plus 80 is 170, right? So those we were able to trace. The common that you see here, we do not allocate those common costs over because we are not, they're saying they're not traceable. I don't know, maybe this 25,000 is the CEO's, well, that'd be kind of a lousy CEO salary, right? But this is the CEO salary, let's say, maybe in 1918. This is the CEO salary, and what? We are not going to allocate this to the departments because just because you get rid of, say, the computer division, that person's salary continues, right? So we don't allocate it. Notice, though, what? In computing the overall profitability of the company, yes, we do include those. So if you think about it, if you were to take the division margin, okay, and we're going to see that in some of these problems, I'll just give you the division margin. If you add the division margin together, then what? You subtract off your common cost. Doesn't that give you the overall net operating income of the company? Right? Okay, we have our what? Sales. The sales are per division. We have the variable cost per division. We have a contribution margin per division. We have traceable fixed costs, which get traced to each division. That gives us a what? That gives us a division margin total. You add those two together, and then you take off the common cost. Doesn't that give you the overall profitability of the company? Okay. Okay, so let's go ahead and let's take a look and see how a couple of these might shake out for us. And this, guys, is the solution. So if you're thinking, well, geez, that's an easy problem because they gave us the answer down there. That's the solution down here. But let's go ahead and let's take a look at this information. We got Alpha and Charlie division. These aren't in your slides, guys, if you're looking for them. If you just downloaded them, unless you just downloaded them, they're not there. But they are part of the homework questions. Okay, they're the homework file. They're in there. Okay, but you've got the sales, and you've got Alpha of 230. You've got what? You've got their variable expenses of 131. Huh? For Alpha. Okay, right. Okay, and then what? Then you're sitting there, and we have the traceable, only the traceable, I mean, very descriptive term, right? Are traceable to the division. Then we go ahead and we do the same thing with Charlie here. So let's go ahead and pick up Charlie. And Charlie has sales of what? 540. Okay, now when you're working this question, you're doing this yourself, aren't you? Okay, so this is the solution down here. 307, and then we take the traceable, right? Okay, and when you do all that, you take your sales minus your variable costs, gives you contribution margin minus your traceable fixed costs that we took to each one, and that gives us a profit margin, segment margin, a profit margin for Charlie, profit margin for Alpha, are my two segment margins, doesn't it? Okay, I add those two segment margins together. There we go. 471, 100. Now, if you're working this on the test, the reason I'm focusing on this column and not the other one, if you're saying, well, what about that other column, John? What was I supposed to do with that? I would not if you're working this on the test, you would do this part. You wouldn't sit here and add everything across. There's no need for it. You're just trying to come up with what? With this number right here, which is my total segment margin. Isn't that the margin of the profit of those two segments? Okay. Then you would go ahead and do what? Pick up the common cost. Do they give me the common cost here? I know they do because I see it down there. It's what? Common fixed expenses that are not traceable. We subtract that off of our profit margins, and that gives us the solution to this question. The overall operating profit of the company is this $27,900, whatever, right? Question? Okay. So you might have to sit here and what? Do this part of the analysis here to come up with the segment margin for each segment. You add those together. That's giving me the what? The profit of each of these segments. I subtract off my common fixed expenses, which I wouldn't allocate to the segments, and that gives me my overall company profit. Okay? Okay, good. How about this one? Okay, now for this one, they go ahead and notice they have the export division and they have the business product division. Okay, and they go ahead and for each one of these divisions, they give me the profit for the what? Export division of 34,300, and for the business division, they give us this 86,700. And then they tell us what? The common costs. Are we going to allocate these to either of these divisions? Okay, but we need to consider it because they've told us the common costs here are this 96,000 whatever. And we know that we need to pick that up to come up with the overall operating income of the company. Okay, and so what happens? I'll just go ahead. Well, there's no need for me to write it. It's right here, right? We pick up what? We pick up that 34,300. That's the profit of the export division. We pick up the business product division. We add those two numbers together. That gives us the what? The segment profit. You take that segment profit of 121 and you subtract off those common costs. Does that give us the overall? Okay. So again, you don't need to have the sales minus the variable cost to come up with this. I could give you a problem, and this is probably a little more efficient way of testing your understanding, that we take our segment profit, add those together, minus my common cost gives me my overall company profit, right? Right? Okay. All right, good. So let's go over then. And take a look at how we will go ahead and figure out things like the break even of each segment. We'll be able to see which segment is more contributing to my profit by using this analysis and understanding that I'm not supposed to trace my common cost to each segment. Okay, so let's just go ahead and let's take a look. And now we're going to take our television division and we're literally going to break out what? Our two products. And we're going to be able to analyze which product of these divisions is the profit that they're providing. Okay, so we come over and remember, and we've seen this slide already, that we have what? We had traceable fixed costs to the television division of how much? 90,000, didn't we? Right, there was 80,000 that was traceable to the computer department. Then we had these common costs of 25,000. Now remember, we said that when you get down to a lower level, you may not be able to trace some costs that were traceable at the department level, may not be traceable at the product level. And that's what happens on this next slide. Then when we come into the television division, remember we had a total of what? 90, but we determined that when we're getting to the product level, which is our regular TVs versus our big screen TVs here, notice that what? Only 80,000 of those total traceable costs of 90,000 were traceable to the entire department. Only 80,000 of that is traceable at the product level, right? And the 10,000 now becomes a common cost. So we go ahead and we take the traceable cost here to each one of these products, and we're able to figure out the what? Product margin now. So now we're not just doing it by division, we're doing it by product, aren't we? Okay. And then, of course, if we wanted to get the whole division, we'd have to take out those common costs that, even though they were traceable to division, are not traceable to the products. Okay. All right, now you come over and let's see how we'll start to analyze the break even of these different products. Okay, and so what happens? We come over, and I guess they decided to spend $5,000 more on advertising, and they're sitting there and they're saying that when they spend that $5,000 more on advertising, that is going to be a common cost, because I guess they're going to talk about the whole store. They're not going to talk about, or they're going to talk about the televisions in this store. They're not going to sit there and talk about the big screen versus the regular screen TVs, right? Okay, so that's considered an additional common cost. It was 10, now it's 15. And notice that what happens here, we increase our sales by 5%, and when we do, there's our traceable fixed cost. There's that 45 and that 35. That was the same as what we had before. Remember, we had 80,000. That's the total of those. And when we do, we get an increase in our margin, and notice the margin in what? In my regular TVs goes up more than the margin in the big screens, doesn't it? Okay, so if you needed to sit there and figure out which of these was more profitable for the company, what would you think is the more profitable? The big screens or the regular screens? Looking like regular screens do more good for the company's bottom line than what? Than the big screens, right? And you're able to see that through this analysis. Any way you think we can prove that? I mean, it's kind of eyeballing it. It's true. Anything more detailed we could do to help us with this? Well, it's clearly a larger percentage, but what I'm thinking about, Nick, is this increase in the profit that came down here, right? Okay, so we have something called contribution margin that first goes to fixed cost and then profit, right? And this increase in margin is telling me that my contribution margin is faster on the regular TVs than it is on the big screen TVs, right? Or more pronounced. Can I prove that numerically? We have the what? I'll put it on the screen. We have the contribution margin ratio, don't we? Do we have something called the contribution margin ratio? Who wants to set up the contribution margin ratio for me? You want to do that, Nick? Okay. You missed that class, so you have no idea. So, like, if a doctor's performing surgery and they open the guy up and they say, oh, his spleen looks inflamed, is the doctor supposed to say, spleen? I didn't go to class on spleen day. Okay, so even if you miss class, you got to know, right? Okay, but that's all right. I'm messing with you, right? Okay, I'm messing with you. This is what people always tell me anyway. They say, John, you know why we mess with you so much? And I say, no, why? I'd like to know. Because we know you can take it. And I'm like, no, I can't. Okay, all right. So what happens? So 45,000. You're laughing. They've really said that to me before. Okay, so we sit here and we take our contribution margin ratio. Contribution margin ratio. Come on, you piece of junk. Sorry. Contribution margin ratio is going to be what? Who else wants to do this? Well, look, take a risk that it probably involves a contribution margin. Okay, it doesn't have to be per unit. You can do it per unit, but you don't have to do it per unit. You can do it in total. Remember we did that little exercise where it's the same. And so, yeah, but you're right. We don't have the per unit, so we're going to have to take the total, aren't we? So you take the what? 110,250, and you want to divide it. What was your name, sir?
Jack.
Jack, you want to divide it by?
The SP, I can't.
Right here, that's sales. You got it. Sales. Right there. 210, right? You're good. So what does that give me? I've said several times that if I see a smile on your face and you're looking at your phone or your iPad or your computer, I know you're not studying managerial accounting. So either improve your acting skills or stop looking at something pleasurable on your phone. Okay? Or both. You have to do, yeah, no, one or the other. That's right. Go ahead.
It's 0.525, so I guess it's 52.5%.
52.5%, you want to say?
I think so, yeah.
Okay. 52.5%, says Jack. Do we have a validation on that? Not that I don't trust you, but I'm just trying to engage others. He says yes to his own calculation. Do we have a validation on that?
Yes.
Okay, good. Like a man with confidence. Okay, so that's 50. He's like, you don't need to verify anything. Yes, it's fine. Okay, good. So now what? Now we're going to go ahead and compare it to what? To the big screens? Right? So who wants to set that up? Go ahead, Jack.
It's going to be 47,250 divided by 105,000.
Divided by 105,000, you say?
Yes.
Okay, good. And what do you get there?
45%.
Huh?
45.
Roughly 45%? Okay, good. Okay, so if you take a look, the contribution margin ratio already told us what our eyeballs kind of confirmed what our eyeballs were kind of seeing there when we did the little eyeball test on it. And then what? Yes, the regular TVs contribute faster to my fixed cost and then my profit than does what? Than does the big screen TVs, right? So even though we're saying that this advertising campaign is not traceable, if you had to talk more about one TV or the other in the commercial, right? Because they give you 60-second spot, let's say, to talk. And you got to say, we've got all these things for sale. We got you can get rid of. You know, ever hear them? Those guys when they talk on those commercials, real fast like that. Okay. So would you ask him to slow down when he talks about the regular screen TVs, maybe, right? Okay. Okay. Good. But you know that that's the one that you're going to try to push. Or maybe when you set up your sales commissions, you'll set it up on the contribution margin instead of the sales price. Because I'd imagine the big screen TV has a higher sales price, right? But it also has more variable costs. Okay, all right, good. So we come over then, and let's see if we can come up with a break even. And we're going to do it both company-wide. We can do it by segment. Okay, we could even do it by product. Okay, so let's just go ahead and let's do it here and see what we come up with our segment break even versus our product break even. Now, if we want to come up with the segment break even, we're going to have to figure out to what extent our division margins will cover our cover our total fixed cost here, which is or I should say our contribution margin is going to cover what? Our contribution margin ratio right here is where I want to analyze. Is going to do what? Is going to cover my fixed costs, which are both my traceable and what? And my common. This is company-wide here now, right? Okay, let me erase those two circles because I circled on the wrong spot. Let me restate. what I just said when I circled in the wrong place here. We're going to want to see to what extent the company-wide contribution margin is going to contribute to what? The company-wide fixed cost, which is going to be my what? My segment fixed cost plus my common cost, right? When we're analyzing this company-wide. Okay? So let's just go ahead and let's take a look at how they'll do that. Okay, and what do? They took just going back quickly, they did what? They took the total of the traceable and they're going to add to that what? The total of the common cost. And when they do, they get this 170 plus this 25, and then they come up with the company-wide contribution margin ratio. Company-wide contribution margin ratio was what? The sales price minus the variable cost company-wide. There was my company-wide contribution margin ratio, right? Right? I mean, not contribution ratio, but contribution margin. And I simply did what? I took the company-wide sales, divided that by company-wide sales, and divided that into the company-wide contribution margin. That gave me the company-wide contribution margin ratio. I divided that into what? Into the traceable fixed cost plus the common cost, because we're doing company-wide, aren't we? And that gave me break-even sales here of 361,111. Now we're just using what we learned from Chapter 5. Okay? Okay, good. Now you come over and you take a look at this question, and this question wants to know what is the break-even in sales dollars for the company as a whole. They give me information about what? Two different divisions, etc., don't they? Okay. So who wants to set this one up for me? What do you want to do first, Jack?
All right, so I'm going to say we're going to do the contribution margin divided by the sales to get the ratio.
Company-wide, right?
Yes.
Okay, good. 470, and you're going to divide that by 668,000, you're telling me?
I believe so, yes.
Okay. Does anyone have help for this guy for this man to give us the contribution margin ratio?
67%.
67%. Okay, good. So I'm going to just make that 0.67. Is that all right? 67%. Okay, good. Now what do you want to do?
So then we're going to add the traceable fixed costs plus the common costs and divide that by 67%.
Beautiful. So we've got what? We've got our total traceable cost by picking up the traceable cost of each department, right? 335,000. If I don't give you that on the test, you'll be able to add those together, right? Okay. And then what? You want to do what to that, Jack?
Add your common fixed, yeah, your common costs, common fixed expenses.
Common fixed expenses. My common cost 73,480. Good. And I divide that by what?
67%.
0.67. Okay, nice. What do I get here?
$609,671.65.
790 what dollars? One?
600,009, 671 and 64 or 65 cents. So 609,671.65.
You got 671? Okay. There's probably some rounding going on here. Probably that 0.67 didn't come out exactly 0.67. Hello?
Wait, where are you looking?
Okay. Yeah, probably make a difference. I don't know. But 609,617 you're saying?
609,671.
Okay. Close enough. Okay, I'm getting tired of this rounding junk. Okay? All right? Okay. Okay, good. Good job. Okay, so what do? We pick up our segment, what? We pick up our overall company contribution margin ratio, step one. We pick up our traceable fixed cost to each segment plus what? plus our common cost. That's how we figure out the break-even sales dollars for the overall company. Okay, good. Could I do a break-even for the foreign? Could I do a break-even sales for just the foreign? Okay, go for it. Let's play jazz with this question.
Well, I'm assuming you set up the contribution margin ratio the same way as with the whole company, except you just take it out either domestic or foreign.
Okay, well, let's do. Are you a foreign or domestic kind of guy?
Let's go domestic.
Okay.
Stay local.
Okay, so you want to do the domestic then? Okay, go ahead.
So we're gonna take your contribution margin from that, which is what is that, 274,130, and then divide that by 347,000.
Divide that by 347,000, you say?
Yeah.
Okay. And we get, huh? 0.79?
Yeah.
Okay. Okay, good. So we got 0.79. So what do you want to do for the break even for the domestic?
Then we're going to add um, the traceable fixed expenses for it, which is 201,000 plus. I'm not sure how to find a common expense for just. But yes,
You don't consider them. The break even for the segment has nothing to do with these common costs that even if we get rid of the segment, those costs are still going to continue, aren't they? So when you do the break even for the segment, don't worry. We just want to know, what does this segment have to do to break even to cover its traceable fixed cost, right? So you're just going to do what with this 201,000?
79% of it.
Divide it by 0.79. Okay, don't memorize. I'm kind of jumping. Don't memorize a formula. 0.79 contribution margin ratio times my break-even sales is equaling my fixed cost. Divide each side by 0.79. Don't memorize a formula, because then you'll end up multiplying it by 0.79 when you get in a hurry in the exam. And I promise you, they will always give you a choice that contemplates that mistake, that anticipates that mistake. Okay, so make sure you always remember we divide it, don't we? Okay, so what do you get here?
254,430.
254,430, you say?
Yeah, and 38 cents.
Okay. I knew. Okay, 0.38. Okay. All right, so I could, on the exam, give you this same exact question and simply change the call to question to say, give me the break even for the domestic, for the foreign, right? Even though in the homework said it's asking you company wide, right? Right?
Yep.
Okay, and I do this every semester, and then this person puts in my evaluation. He said that the questions would be the same as they are in the homework, and they weren't, because they wanted the same exact question. Okay, when I say they're the same, I may very well do that. And so when you're studying for the exam, what do? You sit there and you go through the questions the way they were written. You maybe go through the questions the way we've messed with them here in class, but then maybe you're going to sit there and you're going to mess with foreign, right? Because that may be the very question that you get on the exam, right? Okay? Okay, good. Let's go ahead then and let's see if we can do a break-even analysis now, and let's see if we can do it by segment. Can we do it by segment? You just did it. Okay, so what happens? You come over, and if we're dealing with the television division, we do what? We take where's my television division? We take their fixed costs, traceable fixed cost, and we divide it by their contribution margin, which is the 150,000 contribution margin ratio we're going to divide it by, which is the contribution margin divided by the sales price, right? Okay, so that's exactly what they did there. They took the contribution margin, divided it by the sales price. That gave me the contribution margin ratio. They divided in the fixed cost. They gave me a break even for this segment of 180,000, and then what? And then we sit here and we take the contribution margin for the what computer division now, divide it by its fixed cost, right? Okay. Okay, good. If we want to get the company wide, what do we do? Oh, well, we've already done the company wide, didn't we? We would have taken what? 170. I'm not sure what this slide is saying. Forget it. Who cares? Okay, we know what we need to know now. I don't care what's on this slide. Okay? All right. So let's go ahead and let's try this with a couple of questions from the homework. Let's try this with the K division. They asked us in this question. Who wants to do this one? Jack looks like the guy that just answered all the questions correctly. He's sitting there going, I don't have to answer any of these. Who wants to answer this one? You want to try this one? Okay. What's your name again? Maher. Okay. Yeah, they asked us for K here. Okay. That's going to be needed for the answer, so I'll write that down. Okay. Back up. Let me help. I'll help you. Let me get you started. We need the. Go ahead. Okay. It will be divided by something. Okay. You need. That's okay. You need the contribution margin ratio, don't you? Good. Good. Anyone you want to help her out here? Huh? Point what? 4.7. Okay. 75,000 divided by the 0.47. Okay. Okay, good. And that gives me what? Huh? That's my break even, which is
59574.46.
beautiful. Right? Not for this problem, because they just asked me K. What if they ask me total company? And again, guys, this is probably how I'm going to do your test. I'm going to take the same problems that we worked where they came out and they asked me about one of the divisions, and I'll ask you either about the other division or I'll ask you maybe for the total, right? So you want to help me with the total? Company break even? Total company, yeah. 192, 230 divided by 409, you say? Like that? Okay, good. Gives me 0.47 again? Okay, that's interesting. So happens that the contribution margin ratio of K division is the same as the overall company, which must mean that it's the same for L company, which is like never happens unless we're sitting in a textbook. Okay, but we still happen to have the same contribution margin for each division, 0.47. Okay, go ahead. Good. 40,900 is the common, and the traceable is what, 133? Okay, good. Nice job. 133,000. And you want me to do what with that? Divide that by the overall company contribution margin ratio gives me what? Huh? 370,000? Good. I really like this question now because I don't even have to change the answer choices. Beautiful. I don't even have to change the answer choices, do I? I'd have to make sure I mark C as the right answer on the Scantron, and that's all I got to do. Right? Okay. Okay, we won't do L division, but that might be a good exercise for you. Okay, check out L division here. Okay, good. How about this one? A division. In fact, you know what? I'll let some lucky volunteer choose which one they want to do. Which one do you want to do? You want to do company? You want to do division A, division B? A lucky and wise person. Okay. 155,400. Okay. Divided by 370,000. Good. And we get a contribution margin ratio of 0.42. Okay, good. Good. 97,000, the traceable fixed cost divided by 0.42 gives me what? 230,932. Okay, good. There it is, right? Okay. Question? Okay, good. So let's go ahead then and just think about, what if somebody was advocating taking the common costs and tracing them to the segments, okay? Well, you start to have what? This problem of an inappropriate allocation of the common costs to the segments could lead to a faulty analysis, right? Okay, and so we're much better off not doing that. Okay, so these slides are simply cautioning against the idea of somehow trying to take these common costs and allocate them to the departments in this restaurant here, the bar versus the restaurant part of this drinking and eating establishment, whatever, and trying to allocate it to the two departments. And I looked at this and looked at this. I don't know how they decided that they would take only 20,000 of the 200,000 and allocate it. I couldn't do it on sales price. I couldn't figure out how they got there, but whatever. Somehow they decided that 20,000 would go to the bar and 180,000 would go to the restaurant, and by doing that, you're showing the bar as a what? Loser segment, when in fact it was contributing to the overall profitability of the company, wasn't it? So all this slide is showing you here, and this part of the discussion is showing you, is the danger of trying to allocate common cost. If you mess that up, you could end up making a poor decision, right? This company's going to get rid of the bar. Meanwhile, now they're going to be $14,000 short of what? Of covering their common cost, aren't they? Okay. This guy looks like he's coming out of the bar. Okay. Okay, guys, that's it. Okay. So next time, a couple of things that I think we will do on Tuesday. We are going to quickly look at Chapter 7. There's almost nothing there for Chapter 7. I just want you to be aware of activity-based costing. I'm not going to make you do calculations under activity-based costing, although some people think they're fun. I'm not going to have you do that. And so at that point, we will start to roll into our midterm review, right? And so I'll have to put up some additional questions from chapter 5, 6, a little bit, not much of chapter 7 because we're going to have been talking about chapter 7. So definitely for this first practice midterm, chapters 5 and 6, I'll put a batch of questions there. Start to look at those, I'd say Sunday or so. You should be able to start to look at some of those so that when we reconvene on Tuesday, we can work them through together, okay? All right, guys. I will see you on Tuesday. I know. I'm sorry. Every time I see you, I remember, and then I forget. You have a couple of choices. If you want to come to the office now, we can do that. Okay. Why don't you send me an email then, and I'll take care of it. Okay. I'm sorry. I keep forgetting, but as soon as I see you, I remember. So I'll take care of it. But send me an email just to remind me. Okay. All right. Sorry about that. Hi. Not if they're asking me for the segment. If they're asking me for the segment, I don't consider the common cost. Well, you need to figure it out. You need to, the common cost that got allocated to the division is, oh, I see what you're saying. Huh, that's interesting. Huh, that's weird. Yeah. Yeah, no, you should ignore common costs. I don't know why they did this. This is distracting. That's a good question. They shouldn't have done that. I mean, if that's the case, then it's not common if you can allocate it to the two divisions. So I don't know why they did that. Okay. Yeah, I'll try to fix that on the exam itself if there's any questions like that because that gets confusing. Okay, Nick, take care. Yeah. Okay, sure. Uh-huh. Yeah. Okay, not a problem. I'm not going to take attendance. I've given up on the attendance in these two classes. Both of my accounting 101 classes have decided that they don't want to be here for the lectures. So I'm done. People want to sit there and try to figure it out on their own. That's fine. The reality is that nobody does though, because the average grade was like a whatever it was. Yeah, well, that was when I gave the answers. Imagine what it's going to be like when I don't give the answers. Yeah. Yeah. Yeah, you can.